In this video, I want to discuss variable annuities and go in depth on the reasons why somebody may get set up into a variable annuity. What is it? What are the pros? What are the cons? What are some very important things to avoid and the common mistakes that individuals make when they're trying to leverage a variable annuity? And then some solutions to say, okay, does it make sense? Does it make mathematical sense based on my goals to go with a variable annuity or to go into some other avenue? And making sure that you're sticking your specific goal to that specific lane. So if you're trying to maximize your growth play, how exactly can I try to, grow my money as much as possible and try to reduce the amount of negatives against it? If I'm trying to create some sort of income play, some sort of lifetime income strategy, how to make sure you're doing that correctly. If you're trying to leverage something for a short-term goal versus a long-term goal, like how can you make sure that you're separating specific goals, and then you're creating strategies for those specific goals without trying to just leverage a variable annuity with a jack of all trades type concept and it actually hurting you in the long run, losing thousands and thousands of dollars in the process and thousands of dollars or less cash flow that you may need for your retirement years. So the most basic component of a variable annuity, what exactly is it? A variable annuity is just a variable account that's created with an insurance company. So even if somebody goes to a bank and they say, okay, I'm interested in annuities, and that banker is trying to explain to them, okay, this is a good, variable annuity leverage, it's not set up through a bank. They're going through some sort of outside source through an insurance company to be able to create this variable annuity account. So you have some basic ones, Jackson variable annuity, which I did a review on. You have Bright House, which used to be MetLife. They have a variable annuity. You have AXA Equitable, which they have variable annuities, Prudential. There's a whole slew of different companies that try to offer these variable annuities. And what we've seen is in certain situations, individuals get set up into these plans, not truly understand what they have. And then when they're 2, 3, 4, 5 years deep into this, they're realizing that they're paying a bunch of money in fees and they're not truly getting a benefit that could help out their specific retirement situation. So to make sure that I'm explaining things correctly, I want you to think of any sort of account like a bucket. The way on how an account grows is by the contribution somebody's making into the plan and the rate of return that's coming back. So I use the example, the most basic example. If let's say you took $100,000 and you put it underneath your mattress, your contribution would be $100,000. The rate of return, because it's sitting underneath your mattress, would be 0%. You're not gaining anything. So if you look back underneath your mattress 10 years later, that $100,000 is still going to be sitting there. That's one side of the spectrum. The complete opposite side of the spectrum would be variable accounts and would be leveraged towards investments. So the way on how that works, just like the bucket idea, you have contributions going into the plan and then a rate of return that's going to come back. Now this rate of return, if it's tied to investments or in variable annuity cases, it's something known as sub-accounts, like mutual funds. They could either come back positive or they could come back negative. So let's say hypothetically somebody goes and puts $100,000 into an account, and that's what creates their variable annuity. And the annuity, after the year is all said and done, they had 10% of growth. So now their bucket of money is not sitting at $100,000 anymore. And let's just say there was no fees, it'd be $110,000. Pretty self-explanatory. If the market went up, they're going to capture what those gains are based on the rate of return. If let's say we have another scenario where somebody threw $100,000 into their account and the market lost 10%, well then their remaining bucket at the end of that year would be $90,000. Very self-explanatory. Basically that negative was like someone taking a sword and slicing that bucket. So with variable annuities, it's just an account that's offered through an insurance company. Now, there's a lot of nuances to this type of account. So it's going to act like a variable account. Contributions and rate of return equals what the account balance is at the end of the day, at the end of the year. The type of money that somebody could place into a variable annuity could be non-IRA monies, known as non-qualified money. So like cash, checking, savings, somebody sold a business, somebody sold a house, and it's basically sitting in non-qualified dollars. They could go and place that and create a variable annuity account with a non-qualified account. They could also leverage their old employer plans, such as a 401k, a 403b, a 457 plan, a thrift savings plan. And they could take those monies and roll it over into an IRA, a traditional IRA that's created within a variable annuity. So it's that same sort of concept. So if somebody had 401k monies of 100 grand and they roll it over into an IRA with a variable annuity, well, IRA with the variable annuity would be an IRA worth $100,000, and it would still be growing or losing based on this rate of return mechanism. Same thing with a Roth IRA. Let's say if somebody had Roth IRA monies or Roth 401k monies, and they want to go and take those dollars and roll it over into a Roth IRA, then they would create a variable annuity with a non-qualified account, a traditional IRA, or a Roth IRA. So it's not like somebody's going to go and commingle those dollars, or only, cash monies could only get set up in a variable annuity account, or only IRAs could be set up in a variable annuity account. It's really each one, it's just whatever that qualification is. So a Roth IRA is different than a traditional IRA, which is different than a non-qualified account, and that's how you would separate your variable annuity account. And I know that sounds pretty self-explanatory, but you'd be surprised with the amount of calls that we get in thinking that a variable annuity is different than an IRA or vice versa. So no, it's basically just a chassis, just a type of account that you're creating within that qualification, with that qualified account. So that's basically showing how you could fund a variable annuity. Now, some individuals leverage a variable annuity because they're saying, okay, I want to place my money into an account. I understand that my account, the amount of dollars I place in there is my contributions, and my rate of return is either going to be positive or negative based on the underlying investments, the performance that's coming back. So this is what the individual's physical money is. Sometimes it's referred to as the account value. So that typically means whenever somebody is trying to grow their monies or the monies are ebbing and flowing with the market, if this person passes away, this account value is what's going to get left over to the beneficiaries. Very easy to understand. Now, what individuals try to do is they'll say, okay, or you have financial advisors, which will say, okay, if you're being offered a variable annuity, you have this mechanism of your account growing when the market's going up, going down, growing when the market's going up or going down. It's going to ebb and flow. What we want to do is place an additional mechanism onto this account that says, let's say somebody's age 60 and they want to retire at age 65. There might be something called an income rider that would produce this person X amount of dollars from the dollar that they placed in there. So as an example, let's say if somebody was 60 years old and they put $100,000 in this sort of account, on one side, their physical money is going to ebb and flow with the market, with the performance of the market. And then on the other mechanism will be at age 65 as an example. If somebody put 100 grand in there, they'll be able to receive lifetime income of $5,000 every year to the day that they pass away or them and their spouse pass away. So it's a 5% cash flow from their original deposit, or $6,000 or $7,000. Really, that's based on a calculation account. So an individual says, okay, I want to have my cake and eat it too. I wanted my money to grow, but then I also want it to receive some sort of, lifetime income stream later on so that I'm covering my bases. And that sounds great. In reality, when I talk about the problems, there's a lot of negatives associated with that, where you could have a lot less negatives to your account, put yourself in a much better mathematical position with leveraging the correct income rider with the correct product that doesn't have those fees associated with it. So, but just be mindful. If somebody attaches an income rider, this is the whole conceptual understanding is my money is going to ebb and flow, and then I have this secondary type of guarantee that's associated to produce me some sort of lifetime income stream later on. On top of that, some carriers also offer a death benefit, where they say not only is your account value going to ebb and flow with the market, but then on top of it, we're going to create this sort of guaranteed death benefit roll-up for you that if you pass away and there's still money sitting in the account value, your beneficiaries would not receive what the account value is. What they're going to do is receive what this death benefit value is. So there's death benefit riders that you could add onto an account. So like as an example, let's say somebody put $100,000 into an account and the market's ebbing and flowing and all of that, and all of a sudden this person, passes away and there's $150,000 in their physical money account, but because they added this death benefit rider, their death benefit is sitting at, or their death benefit account is sitting at $200,000. So based on how the terms of that death benefit rider acted, instead of that individual's family receiving $150,000, they'll be able to receive $200,000. And this is just a hypothetical example. Once again, when somebody's looking at this nice shiny object, they're saying, oh wow, I could go place my money in a variable annuity. I can receive lifetime income if I use an income rider. I could receive, or my beneficiaries could receive a death benefit if I attach a death benefit rider to that. That sounds great. And in reality, conceptually, yes, it sounds good. In reality, there's a cost with that. There's no such thing as a free lunch, and there's a high cost with that. So that's why you have to be very careful, because there could be avenues that are more beneficial for what you're trying to accomplish. But just kind of stay with me with what is the variable annuity. A third type of rider that we've seen is something known as a liquidity rider. So let's say if somebody gets set up in an account and they have something known as a 7-year decreasing surrender schedule. So that means if they tried to fully remove their monies from this variable annuity, and let's say they were within 7 years of the account, they could get dinged with some sort of penalty because they did not wait the full 7 years. You have some companies that say, okay, if you add a liquidity rider to this, after 3 years or 4 years, for a cost, you could walk away with all your money. Which in my mind defeats the whole purpose of getting set up into an account, at the get-go. Why would you only leverage this sort of account if you're trying to use it? If this is really meant for a long-term play, why would you try to get out of it quicker? And there's no such thing as a free lunch. They're going to charge you for that sort of liquidity rider, or a majority of carriers charge for that sort of liquidity rider. Say, rather than, a 7-year decreasing surrender schedule, you're only going to have a 4-year decreasing surrender schedule, as an example. So in this, the 30,000-foot view, a variable annuity account could be set up, and it's just like a bucket. It grows by the contribution somebody's making in there and the rate of return that's coming back. They understand that this rate of return is going to be based on the different funding options, the different sub-accounts that variable annuity company is offering. So it's going to go up or it's going to go down based on the market performance. If, let's say, they want to trigger some sort of lifetime income mechanism from this, they could add an income rider. If, let's say, they want to also produce a death benefit that could be higher potentially than the account balance, they might add a death benefit rider. Let's say if they want to have some further control and be able to pull their monies out in a shorter duration, then they might include a liquidity feature onto that, or a liquidity rider. This is a fee, this is a fee, this is a fee. So in theory, if somebody attached all these different riders to it, what's happening with the account? Well, the account's going to grow if the market performance that's linked to it is increasing, or those investments are increasing. So yes, could it give growth? Yes. Can it produce income? Yeah. If you add an income rider, can it produce an additional death benefit? Yes. But is it the most efficient and is it the most effective way to do it? And that's where we want to look underneath the hood. Also be mindful that you have a difference between your physical money, which is known as the account value, versus something known as the calculation account. So how the calculation account works, and this is going to be very specific towards income riders or even death benefit riders at that stance. But basically what happens is when someone's looking to trigger lifetime income, you have your physical money, which is doing the ebbing and flowing of the market, and you have something known as an income base or benefit base that's going to have potentially some sort of minimum guaranteed roll-up there. So let's say if you have an income base that's rolling up by 7% every year, regardless of whatever your physical money's doing, what that makes it sound like is you have a calculation account that's rolling up before you're going to trigger lifetime income. When it comes time to trigger lifetime income, that income formula is going to be income base multiplied by withdrawal rate percentage or payout percentage equals that individual's lifetime income. So if, let's say, the combination of the income base multiplied by the withdrawal rate percentage for company A might be $6,000 if somebody put a $100,000 deposit, versus company B, which might be $5,000, well, the more powerful income rider is going to be whichever one is going to give them the higher lifetime income amount. So to explain this a different way, and this is very important because typically individuals set up their money in variable annuities because they think that they're having their cake and eating it too. They think that they're having growth on their physical money, and then they're having some sort of favorable lifetime income rider to produce them lifetime income later on. And that is not the case. So once again, the way the formula works for cash flow for a lifetime income stream, if we had company A, if we have an individual that's age 60 and they have $100,000 and they say, okay, I have this variable annuity. I want to add on an income rider mechanism. We have company A's income rider says, we're going to give you a 7% roll-up guarantee on your income base. That's a phantom account. It's not your true money. Versus company B says, if we want to go with company B, we have an income rider that'll give you a 5% roll-up guarantee. So we're just using simple interest, just for easy math. If this 60-year-old male placed monies with company A, their physical money is going to ebb and flow with the market, or basically based on their account value is going to ebb and flow with what's going on with the market and any sort of fees. And this secondary mechanism, this benefit base, at the end of year one, the benefit base is sitting at, or the income base, they have different marketing terminology for this, be sitting at 107,000. The next year at age 62, 114, 121, et cetera, et cetera. So at age 65, with company A, this individual's benefit base, or their phantom account, calculation account, is sitting at 135,000. Versus company B, because it gave you a smaller number, individuals automatically assume that this benefit base being smaller is going to produce a smaller income result. That is not the case, because that's only one side of the coin. Your benefit base or income base multiplied by your withdrawal rate percentage or payout percentage, this withdrawal rate percentage is based on the individual's age and what their withdrawal rate percentage is for that specific company. So like if company A, for a male age 65, would only produce a 4% withdrawal rate, versus company B, for a male age 65, produces a 5% withdrawal rate. When you take 135,000 multiplied by 4%, this is going to produce this person, if they gave 100 grand, $5,400, or 5.40% cash flow. Company B, even though this number looks smaller, this would produce this individual a $6,250 cash flow, or 6.250% cash flow with that same $100,000 deposit. So in this example, even though the 7% number looked higher, because the withdrawal rate percentage was less, since the combination of those two, this is what determines, okay, which carrier should you go with if you're looking to leverage an income rider. And income riders are pretty universal, how those concepts work of income base multiplied by withdrawal rate percentage. So this is why whenever you're looking at the top options, one of the first things to realize is with variable annuities and income riders, they are not as competitive as fixed index annuities with income riders. So a fixed index annuity with an income rider can produce a much higher cash flow than what a variable annuity with an income rider could do. So this is why if someone's looking for lifetime income, does it make sense to go with a variable annuity? Does it make sense to go with some other avenue? It really depends on their time horizon, basically which ones are the top results, all of that. But this is looking underneath the hood of how an income rider mechanism works. So I hope that this makes sense. So now you understand how a variable annuity, how the generic shell of a variable annuity works and when someone's attaching riders. So yes, it could give you growth, it could give you income, could give you death benefit, could give you kind of a jack of all trades type thing. Now the problem with these are, and really the underlying theme is, there's no such thing as a free lunch. So just like the bucket concept, you're making contributions into the plan and it's growing by the rate of return. This rate of return is based on the different investments or the sub-accounts. Also think of it conceptually like a mutual fund. Anytime it's growing, that could give you performance or growth within your bucket. Anytime that the investments go down, that's going to be a negative. Someone's slicing your bucket. Now you have these little things called fees that are also at the bottom of your bucket. So think of these little fees as holes in the bottom of your bucket. Well, are they large fees or are they small fees? And typically what we see, especially when someone's trying to add lifetime income riders or death benefit riders or liquidity riders and all these different mechanisms, is these could be very expensive when you're comparing it to other solutions. So already because it's in a variable annuity, there's going to be specific contract charges such as mortality and expense related charges, administration fees that are specific towards variable annuities. So those are already a negative that's coming out of the bucket. So let's say if somebody has minus 1% in contract charges, just basic fund-related charges, that's a negative. On top of it, their investments, they're going to have their own sort of charge, and those investments are called sub-accounts, and think of them as mutual funds. So they could range anywhere between 0.5% to some as high as 2.5%. So let's just say that someone's going to light fees within the different funds themselves. That could add another 1%, another negative, another hole in the bottom of that bucket. Now, one of the selling points was, okay, you want to have your cake and eat it too. We're going to add some income riders onto this. You have income riders as high as 2.5%. Death benefit riders as high as 2.5%, some as high as 3%. So when you start adding on these additional riders, a 2% here, a 1% there, let's just say if you just add on an income rider, you don't even add on a death benefit rider, and this is a very basic type of account, you're already minus 3% in the hole before you ever started pulling out monies from this account and not even incorporating if the market ever goes down. So this is where if the market goes down, you're not just feeling the effect of the downside loss to your physical money, the sword slicing your bucket, but then you also have this constant pressure that's going against the account through those fees. Now, on the flip side, can you have uncapped growth? Yes, but that growth is going to be weighted down, but there's going to be a specific drag to that growth because your monies have to grow higher than what the fees are each year. Now, when we fast forward and let's say someone's trying to trigger this sort of account for lifetime income, what are the negatives that are happening? Well, an individual is going to be taking out withdrawals because they're taking out income, so that's going to deplete this bucket by every dollar that they're pulling out of this. Then on top of it, the different fees that are associated there are going to be dragging on this bucket. And then if there are negative downward market loss takes place, then that's going to be a further compound interest effect that's going to put pressure against this bucket. So you basically have triple, quadruple negatives or compound interest that's working against this account, especially if somebody's hitting their retirement years. Most likely they're no longer making contributions to this account, so they're relying solely on just the rate of return to try to hope that they're going to be having some sort of performance on this sort of account. So these are the different things to be mindful of. Now, I'm just showing 3% worth of fees. Yeah, I've seen some accounts that have had fees as high as 7%, a little higher than 7%. So they could range from like the minus 2% to, minus 7%, minus 8%. There's some really scary things when you start tacking on all these additional benefits. They could really put a large drag on the account. And furthermore, if let's say this person keeps living and living and living, they could deplete this account value to $0. When it gets depleted to $0, typically that individual that thought there was going to be this death benefit waiting for their beneficiaries, that would go away if the account value hits $0. So you have to look at the mechanisms within your account. Unfortunately, with variable annuities, they offer something called a prospectus, where you could, all those details, all the proof is in the pudding of everything I'm mentioning. The problem is individuals do not know how to necessarily read through a prospectus because it could be a few hundred pages. So that's where it's, okay, looking at the charges, looking at all those different things. And that's what we help individuals out on a daily basis, try to understand what they're in, if what they're in is favorable, if what they're in, maybe they might want to do a replacement, or if there's a more viable solution out there. All those different things come into play. So that's where, at any point throughout this video that you have questions, feel free to give our 1-800 number a call. Reference this video so we could assign the correct advisor to help you out with your specific situation. So I hope that makes sense. The fees are really the number one problem with variable annuity accounts, and really the gotchas, the smoke and mirrors effect. Now, I have seen some variable annuities that were set up in the early 2000s that they do have a large lifetime income rider play, associated with it, where, there might not be something else better out there, or, there might just be some account that's really giving this individual exactly what they're looking for, and they made sure to mold it correctly. So not all negatives, there could be a cost for the specific fee, but if the fee is going to generate whatever the best outcome is, well, then it might be, something that's warranted. But typically what we notice is an individual might not understand truly what they're in, might not truly understand what the fees are, what the negatives are, and then that's where there's a problem, because they're paying thousands of dollars or they're wasting thousands of dollars in the wrong direction, as opposed to allowing those thousands of dollars to work most effectively to what they're trying to accomplish. So understand, fees are going to be a drag. Downward market losses are obviously going to be a negative. If, let's say, you have a couple of market hiccups that are occurring, that could be a large detriment. And typically individuals don't realize how either good or bad their variable annuity is until the market starts going flat or starts turning bearish and coming, negative. So that's where it's, very important to understand, and so that you're not left holding the bag when everything goes south and you're paying all these fees and just getting hit with this compound interest in the wrong direction. So I hope that makes sense. Some different things to realize is compare your options. Is this variable annuity that you're thinking to get set up in, is this going to be the best route if you're trying to leverage this for income? Is this going to be the best route that you're trying to leverage for growth? Is this going to be the best route that you're trying to leverage for a death benefit play? Or are there better solutions out there that are significantly cheaper, sometimes don't have an additional fee, that will give you these specific mechanisms? So what do I mean by that? Well, we understand the basic components of this is how a variable annuity grows. Contributions and rate of return. That's the base account. Well, if this base account has minus 2% in fees, as an example, and an individual just looking to place their money into something that's going to ebb and flow with the market, Well, why would they go that route where they could go and customize their variable related account into something that would be more appropriate, that would be significantly less in fees? So as an example, someone leverages low cost index funds or ETFs or no load mutual funds or whatever that is, and instead of their cost being minus 2%, which is a hole coming out of the bottom of your bucket, we understand that the rate of return is going to be positive or negative based on the investments. Well, if somebody has their money and they're investing on their own and they're going to low cost funds, maybe those funds might have 0.10% of total fees. What's a better avenue? A 2%, 200 basis point fee, or a 10 basis point fee, a 0.10% fee? So this is where, when you're reducing the amount of risk and reducing the amount of pressure against your account, it allows those uncapped growth years where the markets are doing well to have less of a drag. So this is why I compare the variable annuities, or typically variable annuities that are sold, I compare them to duck boats. If you know what a duck boat is, it's a half boat, it's a half car. It doesn't make a very good boat and it doesn't make a very good car. So if you're trying to leverage a boat and you want it to get from point A to point B the fastest, you're not going to use a duck boat. Just like if you're trying to leverage a vehicle, a car, and you're trying to get from point A to point B the fastest and the most effective and the most fuel efficient, whatever that situation is, a duck boat is not going to be the most effective route. So that's where variable annuities, yes, it could give you uncapped growth, it could give you income, it could give you a death benefit, but is that going to be the most efficient route? And that's where typically where we see these scenarios, the answer is no. But there are some scenarios that variable annuities can be the most favorable. It really just depends on their situation. So if someone's trying to leverage the best growth-related play, that comes down to what their risk tolerance is. Are they, gung-ho about the market? Are they risk tolerant? Are they risk averse? Based on what that formula comes back or what their risk tolerance comes back at, that's how they could build out a portfolio of, if they want to leverage investments, well, maybe leverage investments the most optimal way with the least amount of fees. So maybe a variable annuity might not be that route. If they're trying to leverage more safe accumulation, why would they go towards a variable account if that variable account has losses and has fees associated with it? So from a growth play, there's different ways to look underneath the hood and to trim that fat and make sure that that person is optimized correctly. From an income play, if you're looking to leverage an income rider, well, is this going to give you the best cash flow? As an example, if you have variable annuity company ABC, and we understand if someone puts $100,000 with ABC, they wait 5 years and they're going to be able to produce $6,000 of income from that $100,000 investment, why would they do that if there's a better option with company XYZ, a hybrid annuity like a fixed index annuity with an income rider, that they put $100,000 in with XYZ, they wait 5 years, instead of $6,000, they're getting paid $10,000 of cash flow. Company XYZ has a lot less of fees associated with it, has no Delaware market losses associated with it, and is producing them the cash flow that they need. So let's say if somebody only needs $9,000 of income, with company ABC, they're going to have to place more than $100,000 to produce that $9,000 of income, as opposed to company XYZ, they could place significantly less monies with that, $90,000 as an example, with company XYZ to produce that same $9,000 of cash flow, as opposed to using the full $100,000 amount. So it's saving them thousands of dollars in the process by getting set up in the correct area. And then from a death benefit play, this is where I don't think that it's justified to leverage a death benefit on a variable annuity. I think that if you want to leverage annuities with death benefit riders, there's more effective plays out there that could give you a higher compound interest, higher death benefits. Maybe a death benefit play would be leveraging an insurance product such as life insurance to accomplish that need, do pension maximization strategies, or strategies where you could trigger lifetime income streams, so therefore pay for life insurance, or just put it into a growth-related account that could be more tax efficient. You're going to basically set it and forget it and not do frequency of trades on that will grow, as per what the market's doing, and that might be a more efficient route. So, all these different things come into play, and it's really just about comparing your options and seeing, is it a problem with what you're trying to produce, or what sort of result that you're trying to optimize? Is this going to be a detriment by leveraging a variable annuity, or could it be a benefit, altogether? So I hope that makes sense. Now, to kind of touch up on some solutions, I pretty much, shit on variable annuities throughout this video, or just telling you, hey, open up your eyes towards these different things, because I've seen it liquidate retirement accounts time and time again. You have to be very careful with it. Now, are there times where variable annuities could be warranted and could be justified? And the answer is yes. For an individual that might be a high net worth individual, and let's say they want to leverage non-qualified or non-IRA monies, and they understand the tax benefits with a variable annuity, they could go and place dollars into a variable annuity, and it could be specifically designed variable annuities that do not have riders, that do not have loads associated with it, and also are 100% liquid right out the gate. So what do I mean by that? Well, let's say if somebody goes and they have $100,000 and they place it into an investment account, such as a brokerage account, and they go and they take their dollars, and we understand that the way on how an investment account grows is by the contributions and the rate of return. So let's say that somebody goes and they take their money, they place 100 grand into a non-qualified brokerage account, and it's just tied to different investments. And we know that the rate of return is either going to be positive or it's going to be negative, and little holes are going to be the little fees coming out of the bottom of their bucket. Well, when someone's placing dollars in a non-qualified account and they're selling, they're buying and selling, they're doing trades, and they have frequency of trades, anytime that they're receiving a gain, that could be result in a short-term capital gain, short-term capital loss, or long-term capital gain, long-term capital loss, meaning that they may have some sort of tax implication. If there's a gain, that they would have to show, okay, they made that gain at the end of the year. So rather than the money growing on the power of compound interest, they're stopping, they're paying whatever that tax is on that gain, and then they're reinvesting those dollars. So that's how a non-qualified brokerage account would work. Now, when we go over the concept of the variable annuity and a non-qualified variable annuity, let's say somebody's in their 60s and they say, okay, I want to place my money into some sort of investments, but I want to make sure that I could do frequency of trades and not get dinged with a tax every single time that there's going to be a buying and selling of those trades. So they might leverage this sort of no load, no rider, completely liquid variable annuity. And there's a few carriers that do offer these that say, okay, my money is going to be growing, I'm going to be placing my dollars in there, that's a contribution, and it's going to be growing based on the investments that I choose. So the actual fees on those are not going to be as high as traditional variable annuities, and they're also not going to be set up in a surrender schedule, like a 7-year surrender schedule, because let's say they want to leverage this account and they want to leverage it for 6 months or 2 years or whatever that is, and they need to access those dollars, they can liquidate those dollars. Now the main difference is there's an additional tax-deferred chassis that protects the growth within that account. Now, because these dollars are non-IRA monies, it works different than an IRA-related account. So with these non-qualified accounts, they could do buying and selling. Let's say somebody had $100,000 that's in that account, and they were buying and selling different trades, all of that. It went a few years out, and now their account's worth $150,000 as an example. If they decide to fully remove their dollars from this account, well, then they would have to pay tax on whatever was above their cost basis. So their $100,000, they wouldn't be paying tax on the $100,000. They'd be paying tax on the plus $50,000 gain that they had, because $100,000 was non-tax. Those are dollars that they've already been taxed on, non-qualified, and that extra gain was what they would have taxes on. So for an individual that's trying to leverage this potentially as a death benefit to say, hey, I just want this account to grow. I want it to try to leverage different investments. I want it to have frequency of trades in there, but I'm not really too concerned with ever touching these dollars. What's going to give this account the best chance for a power of compound interest growth? That's where they might leverage a variable annuity without any riders, or have it completely liquid. But once again, it's for few individuals. This would be mainly for non-qualified money. It's not going to really make an impact if someone's leveraging an IRA account or a Roth account, because you're already having those tax advantages when it's within that chassis anyway. So that's how, once again, I don't want to completely shit on variable annuities. There are ways to leverage variable annuities, but there are very few carriers that actually offer this sort of account, but it could work favorable based on the individual's, their net worth and really their tax situation. So I did want to at least include that in the solutions tab. Now, different things to make sure that an individual could really specify what their goal is. They could look at what their scenario is, where they are right now, where's their point A, where's their point B, potentially what's their ideal retirement date, how to get from point A to point B in the most effective and efficient manner, and then from point B until date of death. And there's something I call the 3-thing scenario. And every individual needs to figure out 3 things in order to properly retire, whether they're gearing up for retirement, or if they're currently retired, how to stay retired forever. The number 1 thing stands for income. The number 2 thing stands for emergency. And then the number 3 thing stands for growth/inflation protection. So in order to categorize how an individual could leverage a specific tool or specific account can be accomplished through these 3 main things. So income, when somebody's no longer working, so let's say we have somebody that's 60 years old or 55 years old, and they say, okay, my ideal retirement date is going to be 65, because I know this is where Medicare supplement, Medicare will kick in, and I want to be exactly age 65 when I call it quits, when I stop working. So at that aspect, okay, how to make sure that your income bases are covered, meaning what are your current expenses right now? What are your expenses going to be in the future? A really quick acronym that an individual could leverage is something known as MUG. It stands for mortgage, utilities, and groceries. What's my mortgage now? What's my mortgage going to be? What's my mortgage payment going to be in retirement? Is this going to have some sort of drop-off? Utilities. What are my utilities now? What are my utilities going to be in the future? Am I going to downsize? What's going to be that situation? And then G, groceries. Basically, am I going to eat out more when I'm retired? Am I going to eat out less? Is it just going to be me and my spouse? Are the kids going to be moved out by that point? So to try to understand what this is, and this is something we help individuals figure out, and we have a more complex way to do that, to really itemize what those numbers are. But if you just want to kind of throw around a number, you could always think of the acronym of MUG, mortgage, utilities, groceries, to figure out what this number is. Once we know what this number is, then we know what the goal is, what that number is you have to get to. So let's say at age 65, we have an individual that they have assets of $1 million. And they're 60 years old right now. They understand after calculating how much they need in expenses, they need to hit $70,000 of income every single year to the day that them and their spouse pass away. So maybe they have, Social Security income between the two of $50,000 total. Well, then this tells us that if they're 60 right now, they have $1 million of assets to leverage. They need to create some sort of strategy to get them to this gap of $20,000 to make sure that they're at least hitting their minimum expenses from some sort of income play, that they do not have to go back to work later on. So this is where, okay, what's the smallest dollars and only as much as necessary that I could peel off of this $100,000 of assets to make sure that I'm placing into something to produce me the $20,000 of income. So this is where you could go to the drawing board and say, okay, do I want to use this through some sort of growth strategy? Do I want to leverage this through some sort of income strategy, leveraging an insurance company and their income riders and their lifetime income guarantees that they could produce? So this is where an individual could go and say, okay, based on what the best options are available, I know if I go and put in $200,000 with company XYZ, it's going to produce me $20,000 of lifetime income cash flow by the time that I hit age 65. So between the Social Security income and the cash flow that they're producing from either the IRA account or non-IRA account, whatever that is, they've only used up out of their $1 million, $200,000, and that was with company, XYZ, with some sort of IRA account that's going to trigger the spigot at that later date and time. So now you move on to step 2, which is emergency. You have $800,000 remaining from that $1 million bucket. What's the smallest dollars that I need in an emergency fund in an oh my gosh moment? Maybe if I have $70,000 of expenses, I want to make sure I have $50,000 in case of a rainy day fund that I could dip into at any time. So out of my $800,000, I'm going to go and use $50,000 and leave that in a checking account, savings account, a money market account, whatever that is. So now they have $750,000 remaining that they could leverage towards a growth, towards an inflationary play. And now this $750,000, maybe they want to leverage $200,000 to some sort of safe accumulation play, $200,000 to some sort of aggressive play, $200,000 to some sort of, death benefit play in there to leave some sort of legacy, another $150,000 to some sort of alternative. So now what they did was they took their assets of $1 million and they made sure to categorize it into 3 different scenarios. When you're able to accomplish the 3 things scenario, and let me clear off the screen, it's maximizing your income so that you do not have to dip into your other accounts. You're making sure that your income is greater than your expenses, so by you making that decision and placing it into an account that was producing some sort of lifetime income stream, that accomplished that need. In that example, it cost $200,000 to do so. Emergency, you needed $50,000 to accomplish that need. So now you have $750,000 remaining in the growth-related play, And this is where you could really be your fund money. So the ultimate goal is to try to have as much money in this growth bucket as possible. But this growth bucket doesn't have to be purely investments. And you don't have to leverage, like as an example, you don't have to leverage variable annuities or variable related accounts. You can use safe accumulation related accounts to do so, or fixed accounts based on what the current interest rate environment is. Or you could use, moderate portfolios really based on what your risk tolerance is. So that's where, by just having each one stick to its lane, you could specify your goal and make sure that you're maximizing it out. The worst thing you could do is say, okay, I have $1 million sitting in this account. I talked to this financial advisor. He told me he could get me some growth, some income, some death benefit. Let me just go and take my $1 million and dump it into this variable annuity, kind of have a jack of all trades type solution. That's a shitty way to go about creating a strategy. And that's something that we see time and time again. And it's not so much the fault of the individual. I blame it more on the fault of the advisor for trying to place them in there and be more money hungry and, trying to increase their compensation by handcuffing this individual to the variable annuity. So be very, very careful with that. So, really the crux of everything is avoid the traps. Understand why individuals leverage variable annuities. What are the benefits of it? In theory, can it give you all these great benefits? Yes. But in reality, if you just go and you specify a goal and you create an individual strategy for each individual goal, you could come out on top spending less dollars, having thousands of more dollars in your pocket, and making sure that you're optimizing your goal. And at the end of the day, just having less stress for, throughout your retirement so that you could, live the retirement that you desire, whether that's golfing every day, working out, visiting grandkids, purchasing properties, traveling the world, really whatever that is, that's ultimately, what the goal is, what individuals, find most favorable as their ideal retirement scenario. So I want to thank you very much for watching this video. I hope that, it helped explain some different things. If you have specific questions, feel free to give our 1-800 number a call. We're available 24 hours a day, 7 days a week. Give us a call. Our assistants will go pick up and then make sure that if you reference this video that we could assign the correct advisor to you. If you found value in this video, you want to see other videos, feel free to subscribe to my YouTube channel, Retire Sharp, so you have access to the most updated videos, and feel free to visit our website, retiresharp.com or fosseyfinancial.com, to navigate and download free reports and different things like that. But, once again, thank you very much, and we look forward to speaking with you.